Welcome to Morningstar. It's been a very busy few weeks for Country Garden as the developer announced its latest earnings report while being embroiled in a liquidity crisis. To help with the latter, the company announced that it would plan an equity issuance to help avoid default and negotiate a payment extension for its outstanding onshore debts. But will it be able to raise as much as it needs? We're talking to Jeff Zhang, our equity analyst at Morningstar. Hi, Jeff. The numbers around sluggish home sales were as expected. What else was of note for investors in the latest earnings report?
We do know that for the developers that we cover, they post very subdued gross margins for property development in their earnings for the first quarter as well, which we think is mainly due to lower selling prices and elevated land costs. Besides, we also note the elevated inventory level in lower tier cities for most developers as the home buying sentiment in those areas remain weak in the first half.
So Country Garden announced an equity issuance. Will it be able to raise as much as it requires? And what would be the impact for Country Garden going forward?
We think that Country Garden engaged in equity issuance to a certain creditor just to avoid a default of its previous debt. So with that already in place, we do expect Country Garden to engage in more of the equity insurance to the creditors for debt equity swap. With that being said, we view that high uncertainty still remains over whether Country Garden could be able to raise adequate amount of funds for its debt servicing, as right now as accessibility to funding remain very subdued.
So after this earnings season, have you adjusted our assumptions and estimates for Country Garden and its property service subsidiary Country Garden Services?
We maintain our fair value estimate for Country Garden this time, as we have previously addressed this high likelihood of default through raising our assumption on weighted average cost of capital while lowering our gross margin estimate. Our fair value estimate for Country Garden stayed at 1.2 Hong Kong dollars. With that being said, we did lower our top line growth estimate for Country Garden Services, given a more competitive market for the China property management. That being said, we still view the shares as undervalued, as Country Garden Services is separately managed from Country Garden with more resilient margins from its asset-light property management services. So that's our findings.
Lastly, what is your base case scenario for Country Garden and the sector as a whole as we enter the last months of 2023?
We think that Country Garden will likely see net losses for 2023 and 2024, mainly given more subdued profit margins and higher impairment provided on the unsold items. And so Country Garden will likely see weaknesses in both top line and bottom line through the next 2 years. However, for the sector as a whole, we do feel that the housing demand will likely rebound through the second half, following more policy tailwinds, particularly in higher tier cities where we see more resilient demand. That being said, we maintain our view for only a gradual sector recovery through at least 2025.
Right. Thank you so much, Jeff. For Morningstar, I'm Caitlin.